听见资本本期视频为您带来的是摩根大通4月4日的闭门会，话题集中在当前大家都在关注的对等关税上。最近宣布的关税政策，你真的看懂了吗？这可不是简单的加税，背后有一套非常规的算法，导致实际影响远超预期，市场应声暴跌，特别是美国资产。摩根大通的顶级策略师们在这场内部会议录音里深入剖析了这场风暴，为什么市场反应如此剧烈？世界各国会如何反击？会爆发全面贸易战吗？更重要的是，这会对本已放缓的美国经济造成多大冲击？经济衰退的警报是否已经拉响？别以为只有坏消息，会议还提到了应对经济疲软可能出台的大规模财政刺激，比如给民众发钱。但这到底是救命稻草还是饮鸩止渴？它会不会再次点燃通胀这把火？面对增长放缓和通胀抬头并存的滞胀风险，美联储又将陷入怎样的两难境地？降息预期还能兑现吗？这一切对你的投资组合意味着什么？警告：过去的明星科技股正面临严峻考验，高估值和集中持仓的风险暴露无遗。策略师们强调，现在是多元化卷土重来的时候，核心债券、另类资产，甚至是被低估的国际市场都值得关注。更重要的是回归基本面，精挑细选，关注估值和质量。想知道如何在动荡中保全资产，寻找机会？接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Good afternoon. I'm Mary Park-Durham, Research Associate here at JP Morgan. In light of the tariff announcements yesterday, which include a 10% universal tariff and increased tariffs on more than 25 of the U.S.'s trading partners. I'm joined by our Chief Global Strategist, David Kelly, and Chief Market Strategist for the Americas, Gabriela Santos, who will lead the discussion. After their prepared remarks, we will take questions from the audience. For those of you joining us via webcast, you can send us your questions using the box on the left side of your screen at any point during this call. And with that, David, I'll turn things over to you.
Great. Well, thank you, Mary Park. Thank you, Gabriela. And thank you all for taking time this afternoon to call into this call. So obviously we've got a very volatile market, a confusing situation. And I think for investors, the most important thing is to have a structured way of addressing this kind of volatility and uncertainty. So what we want to do this afternoon is I want to talk about 5 things. I want to talk about what happened yesterday. I want to talk about how the rest of the world is going to react to the tariff announcements that the president made. I want to talk about what all of this could mean for the economy. I'd like to talk about what it could mean for fiscal policy going forward and what that could mean for monetary policy also. And then I'd like to turn it over to Gabriela to talk about, well, how do you invest in this kind of environment? So first of all, in terms of what happened, we saw a significant market reaction. But of course, we knew for some time that April 2nd was the date that he was going to announce what he called reciprocal tariffs. So why did the market react so violently? Well, I think the reason is because people misunderstood what the president was referring to when he talked about reciprocal tariffs. If you look at actual tariff rates, as of the start of this year, for example, the European Union had an average tariff rate on U.S. goods of 2.7%. Japan had 1.9%. Mexico and Canada less than 1% each. So if reciprocal tariffs mean that we're going to impose tariffs on them of that order, honestly, it's pretty small potatoes relative to what we're already doing in terms of the tariffs on Mexico and Canada that were announced, or the tariffs on steel and aluminum. So it did sound like, yes, we're going to have higher tariff rates, but it didn't sound like a huge escalation. But in the event, they used a different, and I would argue a very unorthodox way of estimating what sort of tariff rates other countries are applying to us, or tariff and other trade barriers and currency manipulation. I think they put it all together in one bucket. But they used a completely different scale. And because of that, as Mary Park just outlined, they announced some very significant tariffs on our major trading partners, with this idea of further tariffs coming also on things like pharmaceuticals down the road. So that is what shocked markets. And that's why we've seen a significant sell-off in the stock market today, with the Dow down 1,500 points at one stage that I saw, and perhaps more, down 1,300 points as we went on the air here. That's what happened. How is the rest of the world going to react? Well, it's obviously headlines all over the world. I think a lot of countries are fairly shocked by the extent and the magnitude of these tariffs. And they will have to react, but I think they have time to respond in each case in the way they think is appropriate. And I wouldn't overstate the degree of retaliation. There will be some retaliation. I think every country will have to, for political reasons, say that it pushed back on what the president did yesterday. But I think this retaliation will be measured for the simple reason that most retaliatory measures would, just like tariffs themselves, could end up hurting them as much as hurting us. For example, you could have a lot of countries saying, well, we're not going to buy any treasury bonds anymore. But if they didn't, that would cause the US dollar to fall against their currencies, which would make the problem for their exporters even greater than it is right now. Or they could say, well, we're going to put some tax on people traveling to the United States and try and cut into the U.S.'s services trade surplus. But of course, the U.S. could retaliate on Americans going abroad for vacation too. So I think the rest of the world really does want to avoid a tit-for-tat trade war, and will try to negotiate somewhat lower rates in the weeks ahead. But there will be some retaliation, and that will be directly, some government official actions in terms of retaliation will be a problem for exporters, and then just public sentiment around the world will have some impact. I am sure that bookings of travel from Canada, but also from Europe and perhaps from the Far East into the United States for vacations will be down this year because of this. So there is some pushback from the rest of the world, but I would say the rest of the world will try not to overreact, and they will be busy. I'm sure that the phones are ringing off the hook at the White House to try to see if they can negotiate some of this down. What could all this mean for the economy? It is pretty worrying. And the reason I say that is primarily because you go back to 2019 when we had tariffs before 2018, 2019. The economy was on something of a sugar rush because of the passage of the Tax and Jobs Cut Act of 2017. So that was stimulating the economy. The economy was really doing very well. And then we imposed tariffs, which do tend to drag on growth and push up inflation a bit, but it really wasn't, that great a magnitude in terms relative to what we're seeing today. Nothing like what we're seeing today. I mean, to think about the magnitude, we're going to show this again on a chart on which we're extending all the way back to, I think, the 1890s. Now we're trying to get this back to, but these tariffs, as they've been announced so far, would not only be the highest since the 1940s, they would actually be higher than the Smoot-Hawley tariffs. So I guess Smoot and Hawley were lowballing it. They would be the highest since 1904, which is 1 year after the Wright brothers. So they would be pretty startling, really, in terms of their overall magnitude. And so we've got much bigger tariffs than you had back in 2018. But you also have this occurring in an economy that was already slowing down, because you've got uncertainty caused by cutbacks directed by the Department of Government Efficiency, which is reducing overall government employment and stalling some loans and grants that the federal government would otherwise do. You've got cutbacks in immigration and very successful sealing of the southern border, which has reduced immigrants coming into this country, but of course also reduces demand and supply, demand for consumer goods and supply of labor. So you've got these things going on also. There is fiscal stimulus. I'll get to that in a minute. There is fiscal stimulus, but it hasn't arrived yet. There is the promise of deregulation, but it's kind of hard to focus on deregulation when you're so focused in a lot of industries on what all this means for the short-term macro outlook. So there's a fair amount of pain in the economy already, and this is hitting at that time. I will say that as of this morning, my own GDP estimates were very close to zero for real GDP growth for the first quarter, and close to zero for the second quarter too. I had a small negative for the first quarter, small positive for the second quarter. So we're kind of close. And if this hits consumers the way I think it's going to hit consumers and hits corporate capital spending and hiring in the second quarter, we could be in trouble here. I think one slightly ominous thing this morning was the unemployment claims data. Initial unemployment claims weren't high. There isn't a lot of firing going on yet in the private sector. But the total continuing claims went up, which suggests that hiring has slowed down. Now, this is a very dynamic labor market in the United States. Basically, people get hired into new jobs at a pace of more than 1 million people per week. And so over the course of the year, maybe like 60 million people get hired and 57 million people leave a job for a net job gain of 3 million. That's kind of the magnitude of this. But we need to hire another million people every week. And if businesses decide to freeze or hold back or pause, you could see some weakness. We're going to obviously look carefully at the jobs report tomorrow morning. Some of the indicators are okay. Some of them are less okay. I still think we'll probably get a positive payroll job gain, but my number has, it's closer to 100,000 than 200,000 at this stage. But I think that most of this is not there yet, but we are worried that the uncertainty caused by this could push the economy into a mild recession. I don't think a sharp recession at this stage, a mild recession. But that brings me to the fourth point, which is what does this mean for fiscal policy? The president also talked about a big, beautiful bill yesterday. I think he was very anxious to try to get his tax plans passed and passed quickly. He did note that with winning 2 seats in the House last night to replace two members of Congress who were appointed to the administration, or one who was appointed to the administration, one who left Congress, and because of the death of 2 Democratic members of Congress, the Republicans now have about a 7-seat majority in the House of Representatives. So if they want to get something through, this is a pretty good time to try and get it through. And the weaker the economy is, the more likely it is that we're going to see significant net fiscal stimulus in this bill. And so this is what we're going to be watching very closely. It's not just does the bill get passed? I think between John Thune and Mike Johnson, they have the votes to get a bill passed. It is not just going to extend the 2017 tax cuts. It's going to do some other things too. I think you'll get a cut in corporate income tax from 15% from 21% to 15% for domestic production. I think you'll see the expensing of R&D and equipment purchases, but also maybe something on the tax on overtime or Social Security, maybe on tips, so that's more complicated. And I think a big question mark here is what about a Doge dividend? If a lot of those cuts would normally occur on the 1st of January 2026, but if the economy is weak in the middle of this year, it's quite possible that the administration will want to the president will want to sign a bill which gives immediate stimulus checks to people. And if you can frame that in where we've got $2 trillion of spending cuts coming over the next decade, so let's take 20% of that right now, $400 billion, and just give that in a one-time check to the American population, maybe $5,000 or $4,000 or $3,000 per household. If you do that, you will juice up the economy. Now, it will, I think, cause the economy to bounce out of any weakness that it's seeing. It's very effective because it is egalitarian. It's, if you give a lot of tax cuts to just the richest households, then it doesn't tend to get spent as fast. But if all households get the same paycheck, particularly lower middle income households, they'll tend to spend it. We saw that with the pandemic. I will say, of course, the one fly in that ointment, apart from the effect on the overall deficit, which is, as you know, very high, is that the last time we had supply chain problems, this is going to cause supply chain problems, and we did big fiscal stimulus in terms of one-time checks, stimulus checks to the population, we didn't just get growth, we got inflation. And that brings me to monetary policy. So over the course of the last 24 hours, we've seen the probability of Fed easing increase. Markets are now pricing in about a 93% probability of a first Fed rate cut in June. And right now they're pricing in more than 3 rate cuts. They're pricing in 3 rate cuts and a 62% chance of a 4th rate cut by the end of the year. I think that's probably a reasonable assessment. I don't think the Fed wants to make a move right now, but if unemployment claims suddenly start moving up, they may feel forced. So we'll have to see how that works. But what I think the Federal Reserve would like to see is, can we see what this fiscal stimulus is? Because if we're going to see near-term fiscal stimulus kicked into the economy, the last thing the Federal Reserve wants to do is further add monetary stimulus to fiscal stimulus at a time when inflation isn't close to their targets. I do think the tariff increases that we've talked about, or that were announced yesterday, will push up inflation this year. I think that we will have, by December, if these tariffs are still around, I think we'll have CPI inflation closer to 4% than 2%. So I do think it's going to add something to inflation that will fade in 2026 anyway, so long as there's no further increase in tariffs. But if you have fiscal stimulus, then and you've got a lot of fiscal stimulus, then you could end up with inflation there. And the Federal Reserve does not want to be party to continuing inflation at well above its 2% target. So it's a complicated situation. We've talked all year about having a more sophisticated defense coming into this year after 2 very good years and increased uncertainty around policy. We've certainly got uncertainty around policy. So, Gabriella, how should people invest today?
Thank you, David. And I think for me, I'd like to focus on 3 main things. First, just taking a look at the market reaction in light of the actions and developments David mentioned. Number 2, the context of what we had seen in markets coming into this announcement yesterday. And then number 3, importantly, what to do in portfolios. So in terms of the market reaction, I think the reading of investors is aligned with what David mentioned, which is much more focused on the downside risk to growth and increasing the risk that there's a bigger cooling, maybe even a recession in the economy. I think it's also interesting to see that there's been quite a risk-off behavior around the world, but a particular repricing of U.S. assets. So, for example, in a classic risk-off move, equities are selling off pretty substantially, but actually U.S. equities are selling off more than what we saw overnight in Asia or in Europe. I think because it was just so much larger and potentially more impactful even for the U.S. So, for example, we've got the S&P down about 4%, the NASDAQ, the small cap index down over 5%, whereas we had a sell-off between 1-2% in other parts of the world in the major markets. At the moment, the S&P is back in correction territory, down 11% from the mid-February highs, a bit deeper for the Mag 7, for small caps, which have now entered technically a bear market, down 20% from their all-time highs. We're also seeing quite a defensive move in the market. Defensives are outperforming cyclicals today by 6 percentage points, which is the most ever. So very much risk-off defensive tilt. In terms of fixed income, we're seeing yields fall across the curve, 19 basis points on the short end to price in maybe an additional 1 or 2 cuts from the Fed. And then on the 10-year also move lower by about 15 basis points, briefly moving below 4% even earlier this morning. Last thing I wanted to point out is the dollar. The dollar, instead of getting stronger like we saw in the first trade war, continues to actually get weaker by close to 2% on top of the 4% we had seen in the first quarter. So I think in line with that theme of an important repricing for expectations in the United States. And this gets me to my second point, which is around the context coming into this policy uncertainty and this potential tariff shock, which is that we just came from 2 very good years for risk assets. We had back-to-back gains for U.S. equities of 20%. We had over 50% back-to-back years for especially a handful of companies, the Magnificent Seven. We had corporate spreads that were some of the tightest we had ever seen outside of a handful of examples. And we had the currency, the dollar, the broad basket, hovering near a range of some of the highest in over 15 years. So there was a certain expectation that things were going quite well here in the U.S. around the AI theme, even some investors after the election pricing in above trend growth with some upside risk. And then in the first quarter and additionally overnight, there's been some downgrade to those expectations, including for U.S. growth and now higher risk perhaps of a recession, but also for specifically those very large cap tech companies, which we'll get to. And I think overall, there were a lot of investors that were quite well positioned in exactly those previous winners, equities within the U.S., within the growth style, and especially a handful of companies. But there were also global investors that were positioned that way. And so when you get that situation where expectations are high, valuations are expensive, portfolios are concentrated, you can get particularly powerful moments like this of repricing and also just rebalancing. We had certain parts of the market that had been quite discounted. For example, 40% discount of international to the U.S., 40% also discount of value to growth. And so you continue to see an important rebalancing within the market as well. Gets me to my last point, what to do. Well, there's no magic bullets, there's no crystal ball, but we can think of a variety of approaches to take, especially around diversification. If we had the pleasure of some of you joining us yesterday as well, when we went through our new second quarter guide, we talked a lot about how this year has been about the revenge of diversification. So core bonds doing their job in these moments when there is a rethink or some concern around growth. With this morning, we now have the 10-year yield down 50 basis points. The ag was up 3% before today. It's going to be up even more. So making sure there is that core fixed income allocation to diversify recession risk. Diversification also in less conventional ways to diversify maybe later any other inflation risks or fiscal risks or unforeseen risks. We find these, for example, in alternative markets with infrastructure, transportation, real estate, hedge funds, or we can find these through hedging strategies, for example, for still being able to be invested in the equity market, but with some downside protection. Diversification also within U.S. equities. And here is where I think there's going to be of course, uncertainty around the world, but in terms of expectations, already pretty low expectations for overseas markets. So we wouldn't abandon that international diversification we talked about yesterday. The last approach I think is really important is around active. So really back to basics and thinking about valuations, quality, fundamentals, really just the nuts and bolts of investing, I think, are really going to matter. Besides valuations, just an example is how each specific company is going to be affected by these tariffs. You can think about it as, all right, but which sectors have a certain high revenue exposure overseas to any kind of a slowdown or retaliatory actions? You would end up by looking at things like technology, materials. But it's not quite so simple. Also, the need to think about suppliers. What percentage of them are found overseas? And then those companies can be affected by these U.S. tariffs, which are harder to get a bit of a clearer read on. And then lastly, margins. What's the ability of these companies to pass on these higher input costs so they have high pricing power versus which companies can and are going to really see pressure on their margins? And around the world as well, similar dynamics. So I think it's really not the kind of investing environment we were in for the last 2 years, but it's one that we've been in before. And it's really back to basics around diversification and around active management. And with that, I'll stop here, Mary Park, and turn to you.
Great. Thank you all very much. And thank you to everyone who sent in their questions. David, I'll start with you. One of the questions we got was, how were the tariff rates that were announced yesterday actually calculated?
Yes, so I did say it was fairly unorthodox. And the way to think about how they did this, or one way I think is, I suppose, so technically the formula was they looked at the trade surplus a particular country had relative to its total exports to the United States. So a good way of thinking about this is, suppose you had a village and you had a tailor and a doctor, and then they were best friends all during the year. And then at the end of the year, the tailor was foaming at the mouth because he realized that while he had spent $20,000 with the doctor had only spent $5,000 with him. And so he sort of storms into the doctor's house. And he says, I can't believe this. I spent $20,000 with you, and you only spent $5,000 with me. So you had a trade surplus of $15,000 with me on a $20,000 worth of services. So 15 divided by 20, that's 75%. You had a 75% tariff on me. Of course, he didn't. But that's literally how those tariff rates were calculated. Now, they were called tariffs charged to the United States, and in the small print it says including currency manipulation and trade barriers. But we don't know that it's because of currency manipulation and trade barriers. It could well be the reason that we've had a big trade deficit for a long time. There are two reasons. One, the dollar's been too high for a very long time. And part of that's our own fault because we've always had this mantra of having a strong dollar. But also because we were in a big budget deficit. I remember I think it was my second class in macroeconomics in undergraduate school, learning that if the private sector funded itself, if investment spending was more or less equal to savings, then mathematically it had to be the case that if the government was living beyond its means, if government spending exceeded taxes, then we were also going to run a trade deficit with imports exceeding exports. That's why they call them twin deficits. They're actually linked in that way. And so, of course, we've got a $2 trillion budget deficit right now. The government won't spend or spend within its means. That is only partly offset by a savings surplus by the private sector. And that means that as a nation, we also live beyond our means, and we end up with this big trade deficit. And that's where it's coming from for the most part, not currency manipulations. But I think it's an important question because, I don't want to get into the politics or even the economics of how do you come up with such an odd calculation as to what the tariff rate some other countries are applying. The problem is, what are these countries supposed to do? I mean, if you're Europe and your actual tariff rate in the United States is running at about 2.7% when you include everything, you get rid of that 2.7%, but it's not going to make any chink on the 39% tariff rate that you were accused of having with the United States. And that's why I think you will see, and I think Vietnam already did this, we'll see other countries cut their tariff rates with the United States to zero, which of course is a very welcome thing. But I don't think they'll be able to make any inroads on those supposed tariff rates or that the president announced yesterday. And because of that, I don't think you're going to see a quick solution here. I think it's not like this is a negotiating thing that the other side can just suddenly fix. They can't really fix those trade surpluses with the United States. Vietnam is not going to have enough rich consumers to buy enough American stuff anytime soon to be able to get to a trade deficit to the U.S.
And I think that's really important, David, because I think there was a certain consensus that whatever the tariff number would be, at least we'd have certainty. But given that formula, how difficult it is for negotiation, I'm not sure that we're at peak uncertainty necessarily. There's still quite a lot of ambiguity about where to.
Well, there is, and I do think that the president has always believed that, historically tariffs were an important part of revenue raising for the U.S. Treasury. And then over time, as he pointed out yesterday, it got replaced by the income tax. Now, the thing about the income tax is income taxes are progressive. Richer people spend a greater percentage of their income in income taxes than poor people do. Tariffs are actually regressive. Poor households spend a greater percentage of their income on goods than richer households do. And because of that, they end up spending they'll pay a greater percentage of the tax. So you go from a progressive tax to a regressive tax, which is really one of the reasons why tariffs, apart from the fact that they just disrupt the economy and tend to slow productivity growth, but that's one of the reasons why tariffs went out of favor for so long. But the president really thinks about this as one way of doing something about our trade deficit and funding tax cuts, which are going to be part of this tax bill. And that's why I think he's quite determined to have that revenue stream. And I don't think these things are going to go away overnight.
Exactly. Especially not the 10% universal ones, which are needed for that revenue generation. Right?
Yeah. Well, I mean, of course, it could. If it's 25% on average, which is where we are right now, that's a lot of revenue generation.
Well.
But,
yes, and speaking of how these were calculated, this was a big topic a few months ago of value-added taxes or VATs. Gabby, could you explain what those are and how they were perhaps included or not included?
So I think there was an expectation, and I'll turn to David to explain a little bit more about VAT taxes, but I think there was an expectation coming to the announcement yesterday, as David mentioned, that reciprocal would be calculated much more narrowly and focused on the tariffs these countries charge us. And one example of that expectation was for Europe, maybe it would just be the stated tariff they have. But there had been previous rumblings that maybe for a country like Europe or the European Union and the variety of countries within it, that actually the president and his team were quite fixated on the issue of value-added taxes. And that's why there was that surprisingly higher than expected tariff on the European Union of 20%.
Yeah, and I think I find this rather odd because most of the world actually does use value-added taxes instead of sales taxes. But it's really very like a sales tax. And the whole key about a value-added tax in this context is, A, it's applied at exactly the same rate on imported goods as domestically produced goods. It's the same rate. But they are high. In the UK, for example, the value-added tax rate is about 20%. In the European Union, it's about 22%. Well, if you call that a tariff, then I suppose the tariff on U.S. goods, you mark it up by the tariff rate plus that 22%. The thing is, it's not a tariff. A tariff is a tax that you apply to imports, but you don't apply to domestic production. Value-added taxes are applied to domestic production and imports the same way. The only difference between a sales tax and a value-added tax is a sales tax is just charged at the sale of the final good or service to the consumer. A value-added tax gets taxed all the way along the supply chain. So if I sell some steel to a factory, they have to pay value-added tax on their purchase of steel to me. But then they can claim back that value-added tax, and as they sell something on maybe a steel good, which would cost say $200, they can then claim back the value-added tax that they were charged, even as they pay the value-added tax on now this higher, more expensive item. And that's why it's called value-added, because you only pay the net tax on the value that you added to this purchase. And equally at the point of sales, the retailer can charge this big VAT tax, but they're able to get back all the value-added tax that was, or they can credit themselves for the value-added tax they paid to all the suppliers. The reason they do it this way is actually to avoid tax evasion for the most part, because everybody involved in the production of something has to fess up to it. So it's not a matter of you're selling it to consumers, you're selling it to businesses. It's really just a more efficient way, particularly if you're going to have a high rate. It's a more efficient way of collecting sales taxes. But it's really no different when it comes to trade. I mean, in the U.S., if the Commonwealth of Massachusetts will charge me a sales tax because I live in Massachusetts, they'll charge me a sales tax on something I purchase. If something is made in Massachusetts, sold in Massachusetts, I have to pay the sales tax. If they sell it to somebody in Oregon, they're not going to charge the people in Oregon the sales tax, but the people in Oregon will have their own sales tax. That's kind of how it works. It's really the same thing when it comes to trade. There really is no big difference between a value-added tax and a sales tax, which is why it's so peculiar to me that this has become part of this argument. It really has got nothing to do with tariffs.
Mm-hmm. Yes, and another question we got was about what authority was this done, and how was it done without Senate approval?
Okay, and I'm sure we'll send it back over to you for questions too, because a lot of these questions, I think the key questions are what do you do now? But so I think it's very important. I think something weird kind of happened over the years in terms of tariff authority. In the 1970s, there were two particular acts passed, I think they were both in the 1970s, which allowed the president to use certain emergency powers to put tariffs on different countries if there was a national emergency. But the legislation itself didn't define a national emergency. So if the president says there is an emergency, there is an emergency. And that gives him the right to do a lot of things in terms of tariffs. So, as you recall, the original motivation for the tariffs on Canada and Mexico not so long ago was because of fentanyl trafficking, which, in the case of Canada was, pretty unfair given how very little fentanyl actually goes across that northern border. An immigration and fentanyl, I think you could argue, is a much more significant issue on the southern border. But in any event, the president could say it's an emergency, therefore put the tariff on. And the only way that you can change that law now, originally it was passed by the House and the Senate, these laws back in the 1970s saying the president can do this. But now you need another piece of legislation which said that the president, we're going to pull this authority back, and the president's not going to have this authority. The problem is you'd have to pass that with veto-proof majorities in the House and Senate to prevent the president from vetoing it. So having ceded this power to the executive branch, it's exceedingly difficult for the Congress to take it back. And therefore, the president has essentially got this until such time as a majority in both parties decide that they would really rather have tariff rates for the long run decided in Congress rather than by the administration.
Perfect. Thank you. And for Gabby, could you see this as other opportunities, or does this create other opportunities in developed markets and in particular emerging markets for investment opportunities?
So I do think this theme of international diversification is still very, very important. It doesn't mean this is going to go swimmingly for really any country out there, but I do think that with every action, there's an equal or opposite reaction. And here I'm not just thinking about how can countries retaliate or not, and actually they may decide to do less on that specific tariff retaliation point. But countries aren't going to stand still given this shock they might be going through for their economies. And I think this is exactly what he had already started to see in a place like Europe. Just the uncertainty about these tariffs, as well as the uncertainty about the U.S. Provision of defense to a lot of these countries. There had already been a big push to do some necessary changes, things like actually abandon fiscal austerity and focus on some more needed fiscal spending, like we saw in Germany with the elimination of the debt brake and the historic nearly $1 trillion euro spending plan on infrastructure and defense, which is just the beginning. That's likely to see more of that in other countries in Europe. But I think this kind of situation actually puts even more of a crisis push on Europe to do even more. For example, with regards to trade, not just them maybe rethinking a bit some of their trading partners, but including within the European Union. They barely do any trade with each other. Former ECB President Mario Draghi wrote a paper last year with several recommendations to boost productivity in Europe. And one of those was just trade more within the bloc. So maybe we do start to see some of that needed change in Europe pushed by this approach from the U.S. Another thing the EU could do as well is around regulation, also a part of that recommendation, in order to attract more investment there as kind of an opportunity. Maybe there is a rethink about regulation in these countries, which we had slowly started to see a bit more flexibility, for example, around climate commitments had started to take shape. So I really do think some of these U.S. policy-driven shocks can actually push a lot of countries to actually make some changes, including, again, that story about Europe. In terms of emerging markets, I think there are certain countries that are just a bit more insulated from this. If we think about India, on paper, India has a tariff that was put on it of over 20%, but it's a much more insulated, domestic-oriented economy and market. So if you think about in terms of the range of countries most exposed, it's one of the least. But what about on the other side? China, Asia, huge exporters. Maybe there are also similar offsetting fiscal, regulatory, or other kind of changes that these countries are set to make as well. Take China, right? Maybe this is an opportunity for China to do even more fiscal stimulus. It's held back so far, but it's likely to do even more to boost its own domestic demand. And of course, a huge push for countries in Asia as a whole to trade more with each other in a bigger counterbalancing regional trading bloc. So as with anything in life, there's always a, shall we say, glass half full way of looking at things. And I think a lot of countries around the world are trying to really pivot their approaches. And that can be something in the medium term that can even be helpful for their long-term outlook.
Great. Thank you. And bringing it back to the U.S., with the sell-off in U.S. equities, have valuations become attractive again? And perhaps even for the Mag 7, or are they still pretty elevated?
So I think for the market overall, when we look at first just valuations, we had seen a bit of multiple contraction this year. Coming into the year, the PE was at 22 times, and now it's at 20 times. That's still substantially above the long run average of about 16 times. We don't think it needs to come all the way back down there. But when you have these moments of uncertainty around earnings expectations that are still very elevated, you need that multiple to come down further ahead of downgrades to earning expectations. That's what we saw, for example, in the first trade war. when it first happened, earnings were fine, but the multiple contracted 20%. And then the next year, earnings expectations and earnings themselves took the hit. So I do think this is not the kind of U.S. equity market that you can look at and say, well, everything's been discounted. Everything is, a screaming buy or a reason to look again at lower quality areas of the market. The last thing I'll say about the Mag 7 is actually, up until now, there had been a 20% correction in the group. The multiple had come down substantially, driven by some rethink of the AI CapEx investment thesis. But this group is actually also one of the most exposed group of companies to some of these tariff changes. 50% of their revenues come from outside the U.S. and 75% of their suppliers come from outside of the U.S. So I also don't think looking for quality equals buying the Mag 7 again. I think it's a lot more complicated than that, on much more on a company by company basis.
Yeah, and I don't think this is the end of U.S. exceptionalism at all. I think that we're seeing certainly this is a difficult moment for the United States, but we still have extraordinary corporations who are very good at holding down costs, at fostering innovation, at taking advantage of any productivity gains. And the sort of crackdown on immigration that we're seeing is going to mean that we're short on labor. But with AI and robotics, I think it's an even greater push to do that capital spending on AI and robotics. So, I think there will also be opportunities for U.S. tech in trying to deal with this new world. When the factories come back to America, it's not necessarily factory jobs. It may be the robots are coming to a town near you rather than the workers, and that could be more efficient. I don't think you can make a shirt in the United States paying workers $2 an hour, but maybe you can find robots to do that.
Absolutely. And by no means do we want to leave the impression that, we're downbeat on the long run perspective here for U.S. companies or U.S. equities. I think it's just a matter of what was expected, what was priced in, and the adjustment period to incorporate some of the uncertainty and some of the downside risks that we now see. And especially after those two amazing years we had, specifically for U.S. equities and a handful of companies within the U.S. But we've been here before. Eventually the market prices it in and it moves on. It goes higher over time, and we will definitely get there again. It's more just about, in the interim, having that balance, for example, between value and growth, and a big focus on quality instead of just pure focus on cyclicality or other kind of back of the envelope ways to pick stocks.
And those are great reminders. We've just gotten a lot of questions about the risk of stagflation and what the Fed would do under a scenario or stagflationary scenario.
Yeah, I've often said that stagflation is not really stagflation, it's inflation stag. And I think that is still the case here. But let me put a footnote around fiscal. So if this were just about the tariffs, and if the fiscal bill or the fiscal package turns out to be relatively, business as usual in terms of just extending the 2017 tax cuts, and I don't believe that's exactly the scenario, but if that were the case, then I think we're definitely talking about inflation stag. We get deflation this year with, as I said, the inflation rate probably closer to 4% than 2%. But then that's kind of it. And the economy does slow down because of the hit to consumers. I think, with that, lower real wages and some wealth effects will slow consumer spending down. But that also will cause inflation to come down. And remember, all of this will tend to slow down the global economy too. So you could easily see lower global energy prices because of this. But I think so that is why I would think that we're talking about a small bump up in inflation, or a bump up in inflation this year. I won't call it small, but a bump up in inflation this year, which is in fact transitory. The sort of two footnotes I put around that are, one, I do think that it's possible that we get more fiscal stimulus because of this, even if that pushes up the deficit further. And of course, we don't know what that does exactly to long-term interest rates, but it could give you more inflation next year. So a slightly longer, more sustained period of inflation. And then I'm also a little uneasy about foreign policy also. I think that it's quite possible that something could blow up in the Middle East which causes oil prices to shoot up again. I think we shouldn't discount that at zero. I think that's always a possibility, and that could, of course, lead to some more inflation. But ultimately, I don't think this is an inflation-prone economy. So in the long run, if you're pricing long-term bonds, I don't really think 10-year treasuries, 30-year treasuries need to be dealing with a sustained inflation rate well above 2%. I think we will get to 2% or below in the long run.
Great, thank you. And just got a question here about small caps or small cap performance. Given they're more domestically oriented, could that be an opportunity?
I think it's tricky with small caps. That was the case before, and that's because they're very, very cyclical. If you look at the kind of sectors that make up the small cap index, it's things that are just direct tied in the vein to the economy. And so the perfect environment for small caps is after you've had a tough period for the economy and you're coming to the other side of it and about to go through a big reacceleration. And coming into this year, we really, I think, pounded the table that it was a bit too early for small caps because there was this policy uncertainty. And regardless, there was going to be a little bit of a downshift in the pace of growth. And now we're talking about perhaps an even bigger downshift in the pace of growth that still needs to be appreciated by investors. And look no further than earnings expectations that were not reflecting that, especially for small caps. Coming into the year, analysts were expecting 40% earnings growth for small caps versus 10% for large and mid caps. But the truth is no one ever knows. For small cap companies, they tend to be revised down during the year by 15 percentage points, and now maybe a little bit more. The last thing about small caps that we still felt was perhaps a bit overlooked was interest rates. They are very exposed to interest rates. A lot of those companies have floating rate loans. And we've talked about the Fed maybe cutting rates, maybe cutting more than expected, but not all the way back down to zero, the way that a lot of these companies had financed themselves not too long ago. So maybe there's a way to focus on still more reasonable valuation parts of the market without having to go all the way to small caps. There's still a lot within large caps, and maybe even mid caps as kind of a sweet spot before you get to small caps.
Perfect. Thank you. And David, we got this question. What are expectations on potential increases in auto insurance and home insurance because of the tariffs?
Interesting. I have to say I haven't really thought about that much, but let's talk about it now. So what's going to happen with both auto insurance and home insurance is you just got to look at the price of the first thing is the price of the thing that's being insured. So there have been plenty of reports recently about how various policy changes might change construction costs. You're going to have to be importing more expensive foreign materials. Although I think lumber was exempted from some of these taxes and these tariffs, but regardless, I think you're going to have more expensive construction materials. But also, we know that unauthorized immigrants who are more involved in the construction industry, particularly the residential construction industry, than in almost any other industry. So if you're short those workers, you're going to have to pay the workers you can find more. So I think those costs of those houses are going to go up, and the higher the cost of the house goes up, the more you have to pay for replacement costs. There are, of course, also issues of natural disasters and so forth, and that's very jagged over time, even with climate change. But I would say this: those home insurance costs could go up a little bit, but I would say more or less on track with the cost of replacing a home, which will go up because of this. So that's home insurance, and then auto insurance. Well, yeah, I mean, we know that foreign vehicle prices just got hit by foreign car prices got hit by a 25% tariff. Foreign light trucks were already hit by a 25% tariff, but that's going to have an impact on average prices. In theory, you say, well, okay, but how about domestic vehicles? And they're not going to go up. Well, they are, because what's going to happen is, if the foreign vehicles are more expensive, then the domestic producers can actually push up their prices too. And a lot of these domestic vehicles have a lot of imported content parts anyway. So I expect that those will go up too. And again, the insurance costs will probably go up in line with the increase in the cost of replacement. But also, again, because of immigration cutbacks, you may find yourself a little bit shorter workers who are actually going to do the repair and maintenance, and that can push up that price too. So I think you get a little bit more. I wouldn't call it a huge shock, but I think it adds a little bit more to both home insurance and auto insurance.
Got it. That's great. And Gabby, a question here. What sectors perhaps are more insulated from the tariff shocks?
Thank you, MP. And I brought actually with me one of the guide slides that's new for the second quarter that we have available in our new guide to the markets that I was actually just checking before this call. It's slide 9, where we're trying to think through some of the policy implications for U.S. earnings. And as I mentioned before, there's different considerations here. The first, which is the percentage of revenue from certain companies that comes from overseas, that could be exposed to a slowdown overseas, or that maybe even could be exposed to retaliation by countries abroad. On the other end of the spectrum, the most insulated by far, utilities. So, but no surprise that they're one of the only two sectors that's positive today. But we also have to think about the percentage of revenues that come from, the percentage of inputs or supplies that come from overseas. And here's where it's actually a little bit harder to calculate. But for example, the 493 group of companies, so outside of the Magnificent Seven, there's on average about 40% exposure to suppliers overseas versus the Mag 7 group of companies where that's much higher at 75%. So I think that helps to explain also why there continues to be that rotation to other areas of the market. And then lastly, the third consideration to think about, not just revenues or input costs, but also margins. Which companies traditionally have higher margins and currently have high margins and hence could absorb maybe some of these costs without too much pressure? Or conversely, which companies have a lot of pricing power and can just pass all of these costs on. And that really is hard to have a generalization across sectors. It's really going to depend very much on each individual company. On the one extreme of perhaps the sector that has less pricing power or less margin absorption ability is consumer staples. That's actually the best sector today, but just somewhat careful with that because it's really going to be company by company because margins are extremely tight in that space, historically, normally, and right now. So it's a bit hard, Mary Park, to be, thinking about a magic bullet here. It's a few variables.
And just two things to add that one of the problems with consumer staples, particularly in the food industry, is I found over time that if lower middle income consumers get hit, you'd think they wouldn't cut back on food, but you know what they do? It's the one thing that they can actually, manage their budget around. They can manage their budget around food and clothing. What they can't manage their budget around very well is utilities.
Yeah.
And that doesn't just help publicly traded utilities.
That's right.
It is also a big positive for having infrastructure. As it's an alternative asset class, but if you can get some exposure to infrastructure in a portfolio, it's really got rather magical inflation and growth protection qualities. It's kind of boring in terms of total return, but I think boring in terms of total returns would be actually kind of a nice thing today.
And no correlation with public markets. So one of those key other defenders in a portfolio.
Yeah, you need the lights to stay on, and you need to when you turn on the tap, the water's got to come out.
Exactly. And a really key question here that we just got, what do tariffs mean for globalization? And is this, the end of globalization?
I think it's in a moment of discovery. Yeah. So I think if we think over the last 20 years, there had already been a peak in globalization, quote unquote, meaning the percentage of goods exports as a percentage of global economy had flatlined. And I think since the first trade war, so 2018, 2019, plus the pandemic, the war in Ukraine, it had really caused a rethink by companies around the world in what supply chains should look like, that they should be more diversified to deal with competition and tariffs between the US and China, and then a whole variety of shocks that can emerge from time to time. So suppliers had really rethought supply chains, focusing on nearshoring and friendshoring, and that way still being able to have resilient supply chains at an acceptable cost for the bottom line. I think where we are now in terms of rethinking is, well, if every single country is getting a tariff imposed, does that diversification of supply chains still work if the end consumer is located within the United States? And of course, that's kind of the intended purpose here of these tariffs, which is to reshore manufacturing activity here in the United States. We'll see how much of that happens or doesn't happen. But I think companies are still going to try to find ways to maintain their margins, maintain a healthy bottom line. And David, you were before talking about that just kind of accelerates AI, automation to keep costs lower.
I think that's right. But also I think it's too early I agree with you. It's too early to tell about globalization because, I've thought for the last few years that Brexit perhaps was a cautionary tale on deglobalization. Britain decided to pull away from the European Union, to reassert its sovereignty on all issues with regard to trade and immigration. But the British economy, which had always flourished under trade, it was really the original trading nation, really has stagnated ever since. It's growing slower than Europe overall and much slower than the United States. And it could be that the United States turns out to be a cautionary tale. Obviously, we want the U.S. to prosper. I think the U.S. has got, some amazing advantages and some extraordinary workers and technology. So we hope that the U.S. does well. But if it doesn't, if these tariffs end up really hurting the U.S., then I think you could see two things happen. One, the world may feel much more inclined to trade with each other. So Europe may suddenly be much more friendly with China and much more focused on getting on with Japan and Canada and trying to establish other networks outside of what's going on in the United States. And also the U.S. itself, if this experiment, and it really is a rather dramatic experiment, if this turns out badly, the U.S. itself may want to go 180 in a few years. I mean, that's typically how American policy works. The trick is, again, as I said, in some ways, it's not the Congress would have to decide, and the president would have to decide whether it's this president or another president to go the opposite direction. But you do need some sort of, you would need some consensus in Washington to go in the opposite direction. So it could take some time. So I think for right now, I'd have to say, if you look at the big numbers on globalization or deglobalization, they're not going to look pretty for the next year or two. But in the long run, I think the jury's still out. Economists believe that globalization probably helps if you can get the currency right, if you get education systems right and other things right. But I think it's a real question mark right now whether which direction we're going to be going in 5 years' time.
And some question marks around also globalization of services, right? I think so far these tariffs, this conversation the past few years has been focused on goods.
Yep.
Whereas the share of service exports as a percentage of global GDP keeps moving higher and higher and higher. So let's see if it gets looped into some of this.
It does, but then there's always these countervailing forces because of the growth in AI. A lot of the services that were being done by call centers in India, for example, can probably be done now. I must say my own experiments in this as I yell. For the 15th time, please give me an age. I just want to talk to a human being. I'm not overly impressed by the early experiments in AI as a substitute for labor, but eventually could get there.
That's true.
Yes, and the U.S. actually has a trade surplus in services. So.
Absolutely. Yeah.
And we have time for one more question. We'll end on the outlook for interest rates, both at the shorter end of the curve and the long run.
So I think. I think it's very uncertain. It depends. Well, first of all, on the short end, I think it really actually both sides. I think it depends on this fiscal package, and one other thing. But I think if the fiscal package comes early and it goes big, then I think a lot of the interest rate decline that you've seen may actually get reversed. You end up with higher long-term rates. I don't think you'll see any higher short-term rates. You might still get some rate cuts, but I think you'll get minimum rate cuts, and you might have a sort of steepening of the yield curve from where it is right now. Longer term, I think it's it's about the fiscal package, but it's also about Fed independence. I mean, the one thing that sort of a little bit of a nightmare scenario for me personally would be if you had a lot of, if the economy got into trouble, but you had fiscal stimulus coming down the pike, but the administration said, we need rate cuts and put a lot of pressure on the Federal Reserve. I think it's very important that the Federal Reserve have that independence. But if they were successful in putting a lot of pressure on the Federal Reserve, then you could get these short-term rate cuts. But I do think that if you have that, the more short rates go down, the more long rates will go up because people would really have some concerns about the dollar. And so, there's a lot going on, but I certainly hope we maintain Fed independence through all of this. I think getting away from Fed independence could not serve any part of the economy well here. But I don't want to. I'll leave the last word to you, Gabby. But I do think this is a volatile time. I think investors need to get good advice. I think it starts with having a structured approach about talking about what happened, how other countries are going to react. What does it mean for the economy? What does this mean for fiscal policy? What does it mean for monetary policy? But also, how should you invest? And it's not just about the opportunities or trying to be tactically ahead of this. I don't think you can be tactically ahead of this. It's a matter of intelligent, sophisticated diversification. And one other thing, I remember somebody asked me earlier on today, what sector would I really want to be in right now? I'd want to be in the valuation sector, the sector that contains reasonable valuations, because in times of stress, people really like to know that what they own is worth what they paid for it. And so I think across the whole spectrum of financial markets, I think it's important to pay attention to the valuation of the things that are in your portfolio.
Yeah, exactly. And I think it's honestly just back to basics in terms of trying to beat some of this policy uncertainty and the thick of the policy fog we're in. So bonds for diversifying recession risk, which are proving their worth again this year. Equities can still provide return if there's the ability to hedge the downside, to rebalance into value international areas that are more discounted. Pockets of alternatives to help with maybe some of this uncertainty. We just talked about inflation, Fed independence, fiscal, and then most importantly, time in the market. We haven't been in this particular situation since the early 1900s, but we've had plenty of situations like these when we've had risk-off moves, when we've had uncertainty, and the markets do price that in. Eventually, they recover way before the policy fog has actually lifted.
Yep.
Perfect. Well, thank you very much. That's all the time we have for today. But thank you both for your insights, and thank you to everyone who tuned into today's webcast. And importantly, if we did not get to your question, please reach out to your JP Morgan representative, and someone from our team will be happy to get back to you.